Are we seeing a reaction to 10-year yields of 3%?
Yeah, I mean, absolutely. I think we all know and we all feel rates are going up. Also, with inventory short across the country, the affordability is less. So people are slow to buy, maybe when they would be a little faster if rates were a little different. But that's the market we're in with inflation, with all the things going on. We're seeing that trend. But mortgages are still very low in general, and people are buying in the housing market.
At what point does an increased mortgage rate start to hit the housing market? We had Jim McCaughan on recently from Principal Financial Advisors, and he had some very specific and pretty alarming things to say.
If rates did back up 200 or 300 basis points, which I don't think they will, but if they did, that would kill the housing sector stone dead, and that would provoke a recession. I don't think the U.S. housing market could take much more than a 3.5% 10-year yield and continue functioning well. So do you agree with that?
Partially. I think that the way the market really is, I don't know if Oksana has some thoughts, but I think there's a lot of things that can change the way the market's going to react, and with rates going up, how things are happening, the market's definitely going to be different today than it is if rates back up 200-300 basis points. But I don't really see that happening anytime soon, in my opinion.
I would also add that let's not forget, we had the housing bubble happen with mortgage rates between 5% and 6%, and subprime rates even above that. Let's also not forget that when we think about households and what effect higher mortgage rates will have on households, households have roughly 3 times more interest paying securities or investments, as opposed to the mortgages, which are the major interest paying liability that households have, and they're generally fixed rate. So higher rates, when you think about the balance sheet impact on households, may actually ultimately be a positive one. And as Matt pointed out, the big issue in the housing market is not mortgage availability or affordability, but really supply.
Yeah. Yes, supply, but we've also seen some, like the SLUs, the loan officer survey from the Fed, for example, auto loans, car loans, demand for those, C&I loans, and commercial real estate loans have all kind of rolled over a little bit in terms of demand, and that does make me question the longer-term inherent demand for housing. Yeah,
absolutely. I mean, right now, with the way the market's moving, rates going up, things changing, the demand is different than it was maybe a year ago or even post-Brexit. But with that being said, now it's more important than ever to be shopping for a mortgage, find a great local mortgage broker that can help you get the right deal for you, because with the rates going up, there's so many different options out there, and we're just seeing that if housing's going fast. If you're not going to get a great offer on a house quick, then someone else will grab it up, and with inventory short, it's really a big part of the market.
Is it more floating rate or fixed that you're seeing?
It's almost exclusively fixed. I think the ARM rates will be much more relevant in the next couple of years, but it's still, people are still very slow with the subprime things that happened years ago.
What are you saying in terms of credit quality? Are people sort of starting to back off on some of the stringent requirements after the collapse?
I think it's a pendulum. It swung very, very tight, and now I think it's easing back. I don't think it's in any risk of some people have talked about, hey, is this going to become the next big bubble? Or it's not happening like that. The mortgage market, the CFPB, Richard Cordy, a lot of those people did a really great job of putting us in a great position for the mortgage industry, and we see it being a strong industry. We don't see it being, it's not too loose, if that's the question.